Hello, Proponomics people, and welcome to the Sunday Supplement Summary from 25th of February 2024. So this week I called the supplement Bank Enders. As you know, I like to try and come up with an amusing title, and that was supposed to be a play on the Bank of England and the EastEnders meeting each other, because it was a bit of a soap opera tale as I analysed a 36-page transcript, which was when the Bank of England, after they've had one of their quarterly Monetary Policy Committee meetings. They have 8 a year, in case you don't know, but once every quarter, they also produce a monetary policy report on the back of those meetings. And that was the nature of February's meeting, which meant there was a report, which also means they're required, after that report, to go to the Treasury Committee and discuss that report with them and answer questions. Now, a little bit of a spoiler alert here. Unfortunately, that whole thing's a bit disappointing because, as you can imagine, the Treasury really care, especially at the moment, about what's politically expedient. So effectively, you could, if you're a bit of a cynic, summarise the meeting as saying, come on guys, when are you going to put the interest rate down so we can try and win the election? Obviously, that's not the spoken bit. And at the end, trying to get an opinion. So 4 members of the Bank of England committee appeared in front of this Treasury committee. And that was the Governor, Andrew Bailey, the Deputy Governor, Ben Broadbent, and then 2 of the external members. There are 4 external members out of 9, so a pretty good, effectively non-executive function, not beholden to the inner workings of the bank, not necessarily beholden to trying to climb the career ladder in the bank either, although, of course, the people who've reached the status of Monetary Policy Committee have arguably already reached the pinnacle or very near of their careers anyway, so perhaps that's overstated. But the other 2 members were Megan Green, who's a US economist, recently joined the committee, very strong pedigree as all the economists do who join the committee, and she's a hawkish realist, I'd describe her as, so someone who wants potentially to make sure the rates are high enough. And then Swati Dhingra, who is the one remaining dove, as we call them, on the committee. So she's someone who wants to try and get the rates down or is concerned about over-tightening in the economy. And she had some really interesting points of view as well. But as usual, the supplement kicked off with going into the macro of the week. So consumer confidence was one of the metrics that I discussed, minus 20. Actually not a bad reading, and I was so sorry to report to everybody that the consumer confidence index has not been positive since January 2016. So just imagine the plight of the consumer and how they've been feeling right now. And that might give you a little bit of a taste as to how they feel about the incumbent ruling party in the country at the moment as well. Certainly looks like they may well be on their way in the next election. And when they look back at why, you might understand why if you look back and say consumers haven't been confident since January 2016. It's a bit ridiculous, isn't it, really? I also obviously got into the bond yields, as I always do, still hovering around the 4% mark. There was a bit of a drive upwards because the flash PMIs were out last week as well. So purchasing managers indices, what are they all about? Well, ultimately, they're looking at the purchasing managers in the big companies, surveying them and saying, are you buying more or are you buying less? Effectively, are you buying in more goods and services in order to deliver your goods and services to add value to those? And resoundingly, especially in services, particularly in services for the last few months, it's been, yes, we are, things are expanding, things are growing. So the services index is over 54. So 50 is a baseline. Anything above 53 is well above the long-term average, and 54.1, which is where services was, is still massive expansion. Now, what does that mean? It means there's more money there because things are growing, so there's more money to pay more wages. And of course, wage costs are increasing this year. And in services, wage costs tend to be one of the main costs because it's normally people-driven stuff. Not always, because there's obviously an awful lot of automation and AI and everything these days. But services expanding significantly, which means the economy's running hotter, which means the interest rate doesn't need to be cut quite as quickly. So that was the thinking in the bond markets. But there was a fairly chunky sell-off on Friday, which took the yield back below the psychological 4% mark, which is kind of that high watermark barrier I've set for the 5-year yield at this time. Might seem a bit arbitrary. There is obviously a bit of room for it to go a bit higher than that, but it certainly still looks like we're trading nearer the top of the range. And for the first time, the Bank of England said in their monetary policy report and at the breakfast briefing that I attend every time there's a quarterly report issued, that they actually largely agree with the forward path of the market's interest rates, or perhaps a little bit softer than that, they don't directly disagree with it. So the bank came out with one of their very famous, very typical, and the markets and some of the commentators have been bemoaning the lack of forward guidance, which is a bit of a joke really, because when they had forward guidance from Mark Carney, they didn't like it. When they had forward guidance, they expected them to do exactly what they said they were going to do, even when things changed. That's just nonsensical, of course. And one of the Treasury Committee actually asked if there should be an equivalent of the Federal Reserve dot plot, which is exactly as complex as it sounds. People on the committee put dots on a chart as to where they think the interest rate's going to be in 3 months' time, 6 months' time, 12 months' time, a couple of years' time, and then beyond. Educated guesswork, of course, but any of those people on that committee would tell you, if the facts change, I'm going to change my mind. And of course, that's what we want. The idea of rigidity or the idea of absolutely guaranteeing where interest rates are going to be is ridiculous and will never happen. Also, Jerome Powell, chairman of the Federal Reserve at the moment, is pretty roundly criticised, just as Andrew Bailey is fairly roundly criticised for communication in general. And the overall feeling is that neither really measure up to some of their predecessors. But of course, we always also have rose-tinted spectacles in these departments, of course. So what was the other big deal? Well, we had to look at what was going on in the labour market, because that's what the Bank of England are also particularly concerned about. In fact, it's their one big level of concern at the moment, is that wages are still going up well beyond where the target inflation rate is. And my own personal concern thrown into the mixer is that services inflation is already high, and it's not even trending in the right direction at the moment. It went from 6.1 to 6.3 to 6.5. Then we've got these services PMIs doing really well. February services figures will tell a story, but I wouldn't be surprised if they were 6.5 again, or maybe even higher than 6.5, preparing for these big rises in minimum wage that are coming along this year, apart from anything else. There was also a pretty good discussion about quantitative tightening. A member of the Treasury Committee had the same concerns that I did, and actually it was the first time the Bank of England threw a few interesting stats out there. So probably three for us to consider here. Number one, they think that about 70% of the rate rise up to 5.25 has been absorbed by the market now. 70%, so quite high. Remember, it takes 6 months plus for all of that impact to be absorbed by the marketplace. So there's still another 30% to go. So we're expecting things to continue to tighten over the coming months, which will still have a dampening effect on inflation because it has a dampening effect on consumption. And that's what DINGRA is particularly concerned about. Consumption dropping off a cliff nearly. December's retail figures were very, very weak. If you remember, they were down over 3%, but then they rebounded completely in January. So looked like either a bit of a false dawn, maybe a blip in the measurements. We just don't know. The ONS are concerned about the accuracy of their unemployment figures at the moment, and we found out they're not going to release the new labour force survey until September, which is achingly far away for those of us who are impatient and would rather have this information in something that looked like real time. So we're stuck really with looking at the level of job vacancies that there are and wage levels on jobs that are advertised and things that are more real-time indicators in the market. There's also the thorny issue of the fact that employment is still down about 1.2% since the pandemic. The difference is on the sick list. Generally speaking, it's not really anywhere else other than that. And of course, the further right of the Tory party are looking to put significant pressure on that sick list. It's a little bit hypocritical, really, isn't it? Because if you look at the state of the NHS waiting lists, that's much more likely to explain the sick list than people wagging and being on the sick. But of course, like always, there's going to be a little bit of truth in both camps, and I'd rather make it apolitical and stand somewhere in the centre trying to be objective about everything. Quantitative tightening, they think the way that the bank are going about it. So remember, this is instead of printing extra money and releasing bonds to the banks into the market, buying corporate bonds, pumping money into the system, it's trying to potentially suck some money out of the system, although it's not really sucking out of the system. What naturally, organically retires as a bond when a bond reaches its maturity is being salted away, and that's obviously removing money from the money supply. But the way that the bank are going about QT is they're selling these bonds into the open market. So they're not actually, removing money supply when they do that. They're just selling those bonds, which actually is pushing the rates and the yields higher than they would otherwise be, because we're not talking about small money here. We're talking about 100 billion here and there. We're talking about significant sums of money. So, of course, there's 100 billion more supply than there otherwise would be demanded in the marketplace. What does that mean? It means that ultimately prices are higher than they otherwise, yields are higher than they otherwise would have been. Prices are lower because supply is higher, which means that yields are higher. And that's why I don't agree with QT, but that puts some colour around it. The equivalent is around about 5.4% at the moment, base rate, rather than 5.25. And then the third final piece of information that I gleaned from last week's report and meeting was that the MPC, the Monetary Policy Committee, still believe that the terminal rate of interest in this economy is between 2 and 3%.